The US banking system, a titan of the global economy, teeters on the precipice of vulnerability. This powerhouse, once considered unshakable, now grapples with a new adversary: elevated interest rates. The Federal Reserve Bank of New York has recently raised the alarm, warning of the banking system's susceptibility in this high-rate environment. You see, the rise in interest rates has led to a ripple effect of unrealized losses on banks' securities portfolios. This, in turn, has caused funding to dry up and capital levels to weaken, leaving the banking system teetering on the brink of instability. This isn't just a theory, it's already happened. Earlier this year, the Silicon Valley Bank fell victim to this high-rate environment, its downfall attributed to these very dislocations. And while it's easy to view the banking system as a monolith, it's important to remember that not all banks are created equal. Larger institutions such as JP Morgan, Citigroup, and Bank of America are less exposed to these risks. Their vast reserves and diversified portfolios provide a shield against capital shortages and bank-run risks. But for smaller regional lenders, the story is different. These institutions bear a heavier burden, their vulnerabilities magnified in the face of these rising challenges. In such a climate, depositors have begun to seek higher-yielding alternatives, increasing the pressures on an already strained sector. As banks have been slow to raise deposit rates, money market funds have become an increasingly attractive option, driving further deposit outflows and increasing losses in securities holdings. This, in turn, requires more funding and weakens capital levels even further. It's a vicious cycle, one that threatens to destabilize an already shaken banking system. The specter of quantitative tightening looms large over the US banking system. This ominous phrase might sound like it's out of a financial thriller, but it's a stark reality we're facing today. Quantitative tightening, or QT as it's often abbreviated, isn't some esoteric banking jargon. It's a method used by the Federal Reserve to cool down the economy and reduce inflation. How does it work? Simply put, the Fed reduces its balance sheet, effectively withdrawing money from the banking system. But as with every action, there's a reaction. Fitch Ratings, a globally recognized credit rating agency, has warned that this QT could lead to a credit squeeze. They've projected that reserves could decrease by $900 billion to $2.5 trillion by the end of the year. That's a significant amount of capital being pulled out of our banking system. Now you might be wondering, how bad can it really get? Well, despite the fact that liquidity in the banking system is currently strong, concerns are mounting. The collapse of Silicon Valley Bank has sent ripples through the financial world, raising eyebrows and anxieties. It's a stern reminder that even seemingly invincible institutions can falter. This brings us to a crucial point. The QT may lead to a decrease in bank deposits. Why does this matter? Because it could worsen credit conditions. Banks would have less money to lend, which could lead to stricter lending criteria and higher interest rates for customers seeking loans. This could have a domino effect, impacting businesses, consumers, and ultimately, US economic growth. So the next time someone mentions quantitative tightening, remember it's not just a phrase thrown around in financial circles. It's a real-world policy with potential implications for everyone, from Wall Street to Main Street. The potential decrease in bank deposits and worsening of credit conditions could have far-reaching implications on US growth. So let's keep an eye on this financial specter and hope for the best. The tremors of instability are shaking the foundations of mid-sized US banks. The crash of Silicon Valley Bank, a regional player, sent shockwaves through the industry, leading to a significant withdrawal of deposits from the mid-sized banks. This massive exodus of capital has made it increasingly difficult for households and businesses to secure loans, creating a potential choke point in the nation's economic engine. Small and mid-sized banks, often overlooked in the grand scheme of the American banking system, play a pivotal role in US bank lending. They are the lifeblood of Main Street, providing crucial financial services to local communities and businesses. However, the turbulence caused by the Silicon Valley Bank crash and the subsequent deposit movements have injected a dose of uncertainty into the system. This uncertainty has led these banks to tread more cautiously in their lending practices. It's a domino effect. The fear of instability leads to tightened lending, which in turn further stokes the flames of uncertainty. It's a vicious cycle, one that could have far-reaching implications on the broader economy. Let's take a moment to appreciate the scale of this issue. The withdrawal of deposits from these smaller financial institutions has left a staggering tally of $5.46 trillion. This is not a small shift, it's a tectonic movement in the banking landscape. It's a stark reminder of the vulnerabilities that lie beneath the surface in the world of finance. The struggles of these mid-sized banks are not just their struggles. They are indicative of broader systemic issues that could potentially ripple out to impact every single one of us. The withdrawal of deposits from small banks has left a tally of $5.46 trillion, signifying a significant shift in the banking landscape. The U.S. banking system is at a crossroads, and the path it takes could shape the economy for years to come. It's crucial to stay aware. Be informed about these issues as they can significantly influence your financial decisions. Knowledge is power, and in this case, it could mean financial stability. So keep your eyes and ears open. Stay tuned to our channel for more updates on this evolving situation. Don't forget to subscribe and hit that notification bell to never miss an update.